Right. Good afternoon, and thank you for joining us today. My name is Natalie Wolf. I'm the Director of Investments at Foundation for the Carolinas. On behalf of the executive leadership team at FFTC, we thank you all for joining us today. If at any time during the webinar you have questions or like further clarification on a specific topic, we invite you to post your questions in the Q&A window. The Bursar team will address these after the presentation during the Q&A portion of the webinar. If we don't get to your question during the session, we will follow up with you after the webinar. The webinar is being recorded and the link will be added to the fftc.org website. I will now introduce Travis Pruitt and Tim Westrich, who lead our consulting relationship at Mercer. Travis will be leading the discussion and will address market conditions and investment performance for FFTC's investment pools during the first quarter of 2024. Travis, you can take it away.
Great. Thanks, Natalie. And thanks, everyone, for joining us again today. Looking forward to a great conversation. In addition to our market items, come on now. I need my computer to wake up. There we go. In addition to the market overviews and the pool's performance, we're going to also delve into a little bit of a special topic this time around the notion of equity styles, specifically growth and value. So we'll give you a little bit of a history lesson and some things to think about as you ponder these notions in the marketplace. But let's start with the overall market. So really pretty good first quarter. So a continuation of what we saw in the fourth quarter overall with strong equity market returns. So you can see for the first quarter of the year, U.S. equities were up about 10%, and in a global environment that was up about 8%. So all in all, really pretty strong returns. The tone of the marketplace changed a bit, but we did still see primary leadership from the U.S. growth side of the market, particularly those big names at the top of the S&P 500. So in the last quarterly call, we talked about this notion of concentration at the top of the index and the perhaps ubiquitous terms now of Mag 7 or the Magnificent Seven. That turned into something closer to the Fab Five, if I could just continue with those bad nomenclatures. But 5 of the 7 names that led the way last year continue to have really strong growth in the first quarter of this year. And as a result, you see the big cap and growth part of the marketplace led the way. We did have some changes in leadership over the course of the quarter. U.S. small cap stocks, as example, were negative in the month of January, but yet posted much stronger returns through February and March to be able to finish the quarter positively. What did change, I think probably pretty remarkably versus the fourth quarter of last year. If you recall from fourth quarter of last year, which was a long time ago now, you may recall that the broader investment community was pricing in a large number of interest rate cuts for 2024 with expectations that we'd hit some rough patch, that inflation would be under control, and that the Fed would be able to be active in cutting the rate environment. That has not come to pass so far this year. And what had been, 6 to 8, is maybe now 1 to 2 rate cut expectations priced into the marketplace. And that window might appear to be closing in terms of just any rate cuts for the year, as we come into the back half of the year and election season. But we can see that priced in during the course of the quarter. A negative return, of course, for bonds means that interest rates went higher, and we did see interest rates go higher as the expectation for cuts backed away. If we look on a one-year basis, just to give a little bit, longer sense, again, 2023 was a really pretty significant year, fantastic year, and up 23% over the course of the last 12 months. And again, really led by that growth engine. And again, those top 5 to 7 stocks at the top of the capitalization tables driving most of that absolute return. So, but you can see just as you look down the page, risk assets in general, whether they be U.S. small cap or even value, those are pretty substantial absolute returns for a recovery environment, really coming off of the weakness that we saw in 2022. So lots of, the absolute returns here, helpful in terms of driving performance in your options across the complex, and we'll talk more about those after our special topic. But I think a couple of the things I wanted to hit on just from an expectational standpoint. Part of the reason that we're seeing these strong returns, we think, is that forecasters have improved their expectations for growth. And you can see that's sort of a wonky colored blue line on the left-hand side that shows expectations for US growth for 2024 going up quite significantly versus where they had been through the course of last year. And that really, again, it runs contrary to what the primary thinking was. This notion back in mid to late 2023 that we were finally going to hit a recession and that would cause rate cuts. That just hasn't come to pass. We've seen a much more resilient economy than most anticipated. And that is really a big part of what's pricing into markets. And you can see on a forward-looking basis for 2025, relatively sanguine views, slower growth, but right now, forecasters largely believe that growth will be positive over that course. The other notion that's really been driving, particularly the interest rate environment, and then by extension equities, is this notion of inflation. And inflation clearly has been coming down, but it is not quite there yet. The blue line representing the 2% target allocation as set forth by the Fed. And we seem to be, hitting a sticking point here in the more near term. I think inflation came out this week. I didn't have a chance to actually review it, but it's not to 2% annualized yet. And we're not quite to that level. I don't know, Tim, do you have a good number on that?
Yeah, it ticked down from 3.5 in March to 3.4 in April. So
Okay.
it's slowly moving, but to your point, it's looking a little bit stickier than initially anticipated.
That's right. Thanks, Tim. And a big driver of that, we think, is that labor markets, one component of it, perhaps at least, is that labor markets continue to be tight. Wage growth, while slowing, remains positive. And as a result, there's a lot of money to spend. The other notion that's not on here is that we continue to run a 6 or 7% federal budget deficit, with an extra $1 trillion or so pumped into the economy than might otherwise be there if we ran a balanced budget. And that can't hurt in terms of maintaining these expectations for economic growth. So we still are, I think, relatively sanguine about economic environment. There are plenty of risks out there that could cause us to tip into a slower growth or perhaps even a recessionary environment, but there's plenty of positives offsetting those as well. So it is not super clear as to where we're going to end up by the end of the year or into next year. I think there are risks to both sides of the equation. And as a result, we continue to work along, as we'll talk about when we get into performance. We do design your portfolios to be able to participate and protect through a wide range of economic environments. And certainly, we would not be in a position today to want to take a lot of excess risk based on a particular direction. So that's our big picture, a macro overview, and I'll relate some of these again back when we talk about specific pool performance. But we wanted to jump into this notion of growth and value. And we'll start with growth and values. These are equity styles, and they're described by some characteristics. And they have been more or less ubiquitous for the last 30 plus years. And I'll give you a sense of that in a minute. But when we talk about growth and value, what exactly are we talking about? So first and foremost, these are notions that apply primarily to stocks of companies, and they apply US and non-US. If we start with a definition of value, there's a couple of big picture things that perhaps define upfront what a value stock is. And in general, it's cheap on some measure. Price to earnings, so the stock price relative to the earnings per share ratio. A low PE ratio suggests a ratio that's cheap on that measure relative to others. And so when you pay a PE ratio, you might pay less of a PE ratio. You might pay less valuation for a stock if it's not growing very fast, or perhaps it's just out of favor. There's other things in the market that have much more exciting growth prospects or lower levels of risk. And so sometimes you will see that stocks trade cheaper than the market or treated cheaper than their own history. because they are out of favor, or they have some problems, some operating difficulties, perhaps some product difficulties. Maybe they've had a change in management. There are a number of things that can cause stocks to trade down in price relative to their earnings potential, and that valuation results in that cheaper valuation takes those situations into account as stock investors attempt to figure out where this name is going to go forward. So value in general, we think of them as cheaper or underpriced on these measures relative to the broader market, and really and in some cases relative to their own history. We contrast that with growth. Perhaps it's that none of this is rocket science. These are generally more expensively priced by some measure. So investors are willing to pay up, again, maybe on this notion of price earnings, if the company's expected to have or is experiencing above average growth prospects. So we'll use a couple of examples here as we go through, but a name like NVIDIA, which many of you, it's hard to have not heard it and be watching markets in the current environment. Investors are paying a high valuation for that stock because the company has delivered pretty fantastic growth and pretty fantastic growth of earnings. And investors, growth investors generally are expecting that growth will continue, and as a result, they're willing to pay more for that stock because they think that future growth is not yet fully reflected in the price. And so they do tend to trade a bit more expensively relative to the market. And the characteristics of these two categories can blur a bit in the middle. And in fact, some index providers do that anyway. Russell indices, which we're going to use today, between growth and value are actually not mutually exclusive. So you can have a stock that sits both in the growth index and in the value index, but they'll sit there in different weights. Whereas Standard & Poor's style indices are mutually exclusive. So a name that might be in S&P growth wouldn't be in the S&P value at the same time. So that definition, or that variation in definition between both index providers as well as managers across the industry can add some confusion as you're looking at what conclusions you might draw around this role of style in a portfolio. Sorry, my computer's refreshing. Oh, please. Okay. Okay. Sorry. Little technical difficulties just for a second. Let me close that. Okay. Sorry. All right. Come on now. Okay. So I wanted to give you some examples of where these sit today. So as of the end of April, hopefully you can still see my presentation screen. Is that still showing, Tim? Okay, great. As of the end of April, the Russell 3000 Growth Index, these are each of the indices we use today. Most indices are capitalization weighted. That is to say, the company with the greatest market cap, which is the current price times the number of shares outstanding, sits at the top. And so today that name is Microsoft. Microsoft has been at the top of some of these indices for a very long time. But in our Russell 3000 Growth, you can see basically it's a who's who of the Mag 7: Microsoft, Apple, NVIDIA, Amazon, Alphabet, which is Google's parent company in two different share classes, Meta, which is Facebook, Eli Lilly, Broadcom, and Tesla. And so these are the largest companies by market cap in the 3000 Growth. And if you know even a little about some of these companies, you can get a sense of just why they're considered growth companies. I use the NVIDIA example. Apple's continued to be able to grow its business, Amazon certainly. And so there are, these tend to trade at above market valuations, so again, on that notion of price to earnings, they trade at higher price to earnings ratios in the marketplace, because it does reflect that these companies have shown certainly more recently above average growth in revenue and in earnings. Contrast that with the names that are in the Russell 3000 Value Index. Berkshire Hathaway is probably amongst the best known of those, and its leader Warren Buffett. But you can see that there's a very different flavor by and large of these companies versus, say, those in the 3000 Growth. 3000 Growth, definitely a technology undertone, as well as technology oriented or technology executed consumer services like an Amazon. Whereas in the Russell 3000 Value, these are businesses that are more or less very well established over. Johnson & Johnson and Procter & Gamble are both over 100 years old, and these are just solid, stable kind of chug along consumer good businesses, as well as a couple of energy companies, and certainly some banks that you all would be familiar with from the neighborhood. So a different flavor of names that are that, if you will, that sit at the top of the Russell 3000 value. We do see the market environment change and leadership change over time. And we're going to talk more about that in a second. But I wanted to give you a sense of what the current Russell 3000, which is the benchmark we use to measure the US equity building block within your portfolios, just to give you a sense of where that tilt lies today. And you can see that as this list populates in green, the top 10 names in the Russell 3000 today, 9 of them include the top 10 names of the Russell 3000 growth. So there is a bit of a growth tilt at the top of the index today. Berkshire Hathaway, it came in, it was subtle, but Berkshire Hathaway is basically number 8. And so we have seen a lot of leadership in the Russell 3000 in American markets, particularly from these more tech-oriented, growth-oriented consumer names that are on the left side of the page. So I think that's interesting. I didn't have the data handy, but if we were to go back and look at a previous time period, we would see more of the Russell 3000 value as example, maybe from the early 80s. We would see much more leadership from those types of companies, just given where we sat in the economic environment at the time. So one question, we get asked this often, and I think the answer has perhaps changed over time, but is there a premium to a particular style? That is to say, is there an advantage to owning growth over value over long periods of time? Can you get a durable, absolute, and maybe even risk-adjusted return by taking a growth or value bet over time? And I think the answer is going to appear to be, because it depends. And it depends on when you start and when you end. So if your investment experience is 10 to 15 years in scope, it would be easy to conclude that the growth style has a durable premium over the value style, because that's exactly what we've seen over the last 10 years. So this chart is an excess return chart. The dark blue line is the rolling 3-year excess return over the Russell 3000 for the growth index for the last 10 years. And the light blue line is the mirror image of that. It's the rolling 3-year excess return for the Russell 3000 value versus the Russell 3000 index. Again, these are rolling 3-year periods on a monthly basis going back 10 years. And so what this demonstrates is that if your investment experience started in the early teens your impression might be that growth is about the only way to go, because it certainly has had a tremendous period of outperformance, particularly here in 2020, which we'll talk about in a minute. But it's been pretty durable. There's been blips of life from value, but it's been pretty durable space. But if we look at the same chart going back 40 years, the story does change a little bit and does reinforce this notion of it depends. One of the seminal items in this growth value conversation came with the Fama French 3-factor model published in 1992, which coincides actually when I graduated from college. So that's about the string of my career starts with Fama French. And you can see that in the period prior to that research being published, there was actually a pretty good value premium. Wasn't really thought of in the same way as it is today, but cheaper stocks performed better. And in part, it was some of those names like Exxon, Chevron, much more durable, sort of the energy companies, banks did really pretty well in here. That changed a bit as we came into the early part of the 1990s. And then there was if you will, a bit of reflexivity following the publishing of that material. And having lived through that time, I suspect there were some people that took the gospel of Fama French, which did suggest that value was a superior style over time. That was a feature of the outcomes of that study, that some may have actually rushed into value shortly after that was published, and you could perhaps see it in these performance numbers. But nothing lasts forever, and so we did see near the end of the last decade of the 20th century, we did see the introduction of Internet 1.0, and really the cascading effects of the year 2000. and the amount of money spent on technology, and particularly technology. Now, remember, I want to say at the end of 1999, technology made up 33% of the S&P 500 in terms of market capitalization, perhaps not remarkably different than today, driven in large part by spending that was brought forward to prepare for the Y2K bug or the potential for the Y2K bug. But again, nothing lasts forever. As we came out of the Y2K environment and planes didn't fall out of the sky and businesses didn't stop working, we also saw that they didn't also need to spend nearly as much money as they had before then to support growth. And we saw the earnings and revenue fall off of those market leading stocks. And we saw a recovery for value. And in fact, a recovery that lasted in part by an extension of credit, lowering of interest rates, both in response to TMT, but also for those of you that recall, in response to the 9/11 tragedies. And by increasing credit in the system, by reducing interest rates, we were able to keep the economy on footing. Perhaps that went on too long, and it manifested primarily in the form of housing and a future housing bubble, which leads us to the global financial crisis. And as a result, those market-leading companies in the value indices, banks in particular, sold off and had challenges, and we saw a recovery in the growth half of the market. We sort of treaded water there for a little while, and then along came COVID. And COVID was a bit different, perhaps, than in other places, but driven in large part, again, by this notion of lower interest rates, longer duration assets, but different from, say, the post-TMT environment. That was driven by, by consumer goods and by other coinciding with the outbreak's the wrong word, but the uptake in different kinds of technologies and really almost Internet 2.5. And as a result, we did see growth stocks, which had led into 2020, lead throughout the post-COVID environment until just recently. So I think the answer is there a premium? Is it really does largely depend. And it's very difficult, as you can tell, perhaps by these conversations, as to which one's going to lead. And in any given calendar year, it can really have the style change in leadership can really have an impact on results and on your point of view. So if I just isolate a couple of years, again, I talked about 2020. 2020 was a unique moment in time, and it also reinforces that just as soon as you think you have a rule about things like style, the market universe will come back and smack you in the face and tell you that you don't. So historically, the style that had led coming into a market crisis had not been the style that would lead through it and lead on the way out. But that's exactly what we got in 2020. Growth had led in 2019. In a negative year in 2018, it led. You'd seen a pretty good growth leadership for those years. And then in 2020, when COVID hit, the world closed, and we saw pretty strong support from the US government. It was actually those same technology companies, as well as other new technology companies or technology-oriented consumer products, consumer services companies that led the way. And so while we might think that value might protect us a bit more on the downside when a market crisis happens, 2020 suggested that there's just no hard and fast rules. They provide guidelines and some expectations, but reminding us to not bet the farm on any of those kinds of notions. We did finally see when interest rates corrected and perhaps we went from this long-term era of free money into a much more normal-ish type interest rate environment. We did see those high expectation stocks sell off. You see expectations for their growth rates come down, and we saw that in 2022, but that was relatively short-lived as we saw it bounce back in 2023. So the notion of living through a durable premium or experiencing a durable premium growth and value is also challenged by having to live through every day and every year in and year out, and seeing the changes in market leadership. And certainly, depending on what your frame of reference is for financial history, will definitely influence how you think about style in your overall portfolio construction. So just a couple of tables I want to hit on this last point. I do think I mentioned this point about when, it's point specific. So if we look at the 10 years ending March, last 10 years have really been dominated by growth. Standard deviation is our measure of variability or risk. And so the higher the level of volatility, the more uncertainty there is, and therefore we indicate those assets are riskier. And so while the Russell 3000 value is underperformed, it's also experienced a little bit less risk, but very similar levels of volatility. Maximum drawdown is just peak to trough. So we go from a good time to a bad time. How long is that, and how long did it take to recover? Is the data point here, and those drawdowns are pretty similar. Around 30% peak to trough price drawdowns. Took a little bit longer for the growth index to recover than the value index, but again, not remarkably different. But these stats are really captured in our up market, down market, and so up market capture suggests on an average monthly or quarterly basis, if the market is up 1%, Russell 3000 value would capture just about 70% of that, or 0.7%, whereas the 3000 growth over this 10-year period got a lot, about 1.4 times the market benchmark return on average. And they both experienced about the same amount of downside in those average periods. So, definitely it's been a growth decade for the 10 years ending March. If we run that back to the 10 years ending 2014, much more balance. And in fact, I recall at this point in my career, definitely, and I still believe this over the very long term, but that, style maybe didn't matter, that you got a lot more wash, that you got paid to have some diversification to live with those calendar year differences. But the outcomes really weren't all that different. You can see the data here. The performance was about the same. Volatility was about the same. Drawdowns were not remarkably different. And the participation in up and down markets also very similar. If we go back to the 10 years ending 2004, which is almost the first decade of my career, you can see the story was different. Much more performance dominance by value over growth over that period, much lower experienced volatility, very different experience in terms of max drawdown, albeit interesting, even in this environment, the upmarket captures were very similar to where we sit today, but it was the down market avoidance, really was avoiding perhaps some of the downside over that period versus the downside of the growth that mattered. So, I show these not to perhaps try to prognosticate, because I just don't know where the next leg is, but I do think it's instructive that there are no hard and fast rules around the implementation of style, that each decade or period of measurement starts with its own set of characteristics, and then will be influenced heavily by those characteristics to follow. And sometimes the story doesn't play out as you might think based on your own financial history. So I think this it's a really nice basis to think about then how do we build your portfolios. So within the U.S. equity, we are in the midst of making some changes to the U.S. equity building block. It has historically been slightly different, but on the new structure, which will be put in place here over the next month or so, we have the core S&P 500 index. So we have our passive large cap core, and then we all have 3 active small mid managers. So GW&K is the one active manager we're holding over. They are small mid core with a slight bias to growthier companies. And then we pair off for diversification benefit, a specialist in value in the form of Victory and a specialist in growth in the form of William Blair. Again, knowing that these should zig and zag differently from one another if they both add value versus the primary benchmark over time, but they do so in different ways and in different cycles, then we think that reduces the overall risk of the option while still pursuing that excess return. Story is much the same in the international fund. Again, a specialty active funding currently, but 2 basically core positions with specialists in LSV and value and American Century in growth. And then our emerging markets portfolio is much more core oriented because the styles have a little bit more excess volatility in emerging markets. And so we're core growth, the core value, and our core index within the emerging markets. So we take all those notions into account. We build the portfolios again to find what we think will be the right mix to generate excess returns over time, but to do so within a nicely risk-controlled framework. So with that, I am going to migrate to the pool recaps, and I'll spend a few minutes here, and then we'd love to take some questions. So for the quarter, I mentioned, the story was really pretty good, and long-term interest rates rose over the course of the quarter. But certainly the short end of the curve. So we didn't talk about it so much today, but the yield curve is still inverted, and so there is higher yields for shorter maturity and bond investments. So that would include cash, which is our top line here in terms of money market funds. It wasn't that long ago that the return for money market was close to zero. Now the overnight rate is 5.25 to 5.5, and so you can really see that reflected in the nearer term returns for the cash. Similarly, for the low duration fixed income, a little bit about 1.5 years in terms of average duration, around a 2 to 3 year maturity. You can see the returns are a little bit less, again, reflecting that inverted yield curve that we're experiencing today. And then income and growth is 60% in fixed income, 40% in equity. And you can see the influence of the equities over the course of the quarter, as well as the course of the year. It's been even our most conservative stock bond portfolio has generated really pretty solid absolute results and nice little premiums here for the quarter and the 1 year trailing period for that strategy. When we switch our focus to the longer term pools, the passive long-term growth gives us the exposure to, again, a 75% global stock, 25% US bond portfolio. And you can see that starting point was around 5% return for the course of the quarter. And again, reflecting some of those stronger numbers I showed you previously in the market recap, up nearly 16% over the trailing year. Active long-term growth, which has the same basic 75-25 structure, but has a blend of active and passive. Nice premium for the quarter. So as the market broadened out, it gave us opportunities to outperform. We're happy to see that. About in line with our specific benchmark over the last year relative to the passive option, about 50 basis points or 0.5% better return, active versus passive. We're happy to see that as well. The ESG pool, which integrates the higher sensitivity to environmental, social, and governance issues, as well as has a diversity lens where able. A little bit underperformance here in the period. There's been a lot of divergent factors driving returns, so we did get a little bit of underperformance in that portfolio for the quarter, but a really nice 2023. Just again demonstrating the vagaries of underlying styles. And then finally, diversified long-term growth, good outperformance. Most of the outperformance from active management this quarter did come from our active fixed income and our international equity, and we can see that both in active long-term growth as well as diversified. And just as a reminder, the diversified long-term growth does have a fair amount of its allocation to stuff that's not daily valued, so private equity, private debt, private real estate, and those assets have not, if you will, caught up yet from a performance standpoint relative to, say, public markets. So it is underperforming the broader public solution, but it is a bit of a flip, if you will, I think was the term we used, from, say, 2022, where you can see it also didn't participate as fully on the downside. And that's really what we hope to achieve between those two portfolios, is that we want to get a great long-term return out of both, but they're going to have slightly different short-term risk profiles. So I think that's it. So I will pause there, and Natalie, I will hand it back to you to field questions.
Thanks, Travis. Please put your questions in the Q&A box. It is at the bottom of the screen. Just press the button and the Q&A box will pop up and you can put it in there. Wait, actually we have one already. So you mentioned yield curve earlier. So what is your view of the recent predictions based on yield curves that indicate a severe recession in 2024 or 2025?
So our house view is the possibility of a recession near the end of this year or perhaps into 2025, but I wouldn't say that's a strongly held view, in part because of the mix of data that I mentioned before. The employment continues to show resilience, albeit again, like anything, it is weakening a bit at the margins. But jobs continue, people continue to have jobs and they continue to spend money. that one might presume that that could tail off because we are, in a classical sense, we are much closer to the end of an economic cycle, or at least it feels like we're much closer to the end of an economic cycle than not. And Tim, I take your check on my memory on this. I think even in a recessionary environment, we are not calling for a severe recession. And I think the yield curve inversion, it certainly hasn't been a good timer of recession because we've been inverted for quite some time. And so we're even in a recession, I think we do think it will has the potential to be shallow. But I don't know, Tim, if you'd add anything on that.
Yeah, I just took a look at our scenario analysis where we model out 8 or 10 different economic scenarios, and we try to handicap the probability of each. And right now, certainly the most likely in our base case is we see continued growth, but a little bit of a slowdown in inflation. It's largely that soft landing where we see portfolios kind of generate mid to high single-digit returns. So there's certainly events and outliers, that could trigger it, but those scenarios really would require a substantial pickup in inflation, a fall off in growth, and that's kind of factors that we don't see transpiring in the near term.
Excellent. Thanks, Tim.
All right, thanks. Question on growth and value. So artificial intelligence developments would seem to benefit growth stocks due to new discoveries and value stocks due to lower costs. Should AI developments cause one to shift their mix between value and growth?
So that's an excellent question, and I think in part answered by the preamble to the question. There will be companies, I hate to say there should be companies that benefit from a growth perspective because they come up with a better widget or a better take on artificial intelligence, and they're able to sell that in such a way that they grow their earnings, perhaps exponentially at very high rates that would promote performance in the growth portfolios. At the same time, if AI meets some of its promise for industry, companies that have tighter margins or older businesses or the ability to improve productivity, which could be perhaps shifted bottom line to their earnings growth, their stock prices might also strongly benefit. If you take a company that has trouble with execution and AI can improve execution remarkably, the stock prices ought to eventually reflect that. So I do think that there's opportunities on both sides of the aisle, and from our perspective, we don't believe we have an edge in determining just how that will play out. And as a result, we would be much less likely to shift our growth value tilts in the portfolio to try and take advantage of that, because just looking back over that 30+ year history of data that we saw, ultimately at some point the last grain of sand goes on the leadership pile and then the pile crumbles, and it's not always clear what that might be. So we think we can benefit from both. We want to have exposure to both in the right risk framework.
Another question coming in. How do you handicap the possibility of inflation significantly increasing, causing the need for additional rate hikes over the next 6 to 12 months? I don't know if that's a golf reference of the handicap.
But no softballs today.
Anyways, I'm taking that
awesome. Yeah.
Not sure you want to interpret that. That's a good question.
It's a great
is there
question.
possible that inflation increases and we'll need additional rate hikes?
I think I'll take those separately. I do think there's a possibility that inflation could accelerate. I don't think it's a high probability. I think the higher probability is that it just doesn't reach 2% anytime soon. There's a lot of stickiness in housing. We haven't seen we went through a series of layoffs over the last 12 months, and yet didn't really translate into fall-offs in wage growth. And so I think as long as those notions stay in place, it's hard to handicap both a significant fall in inflation and a recession, right? Because those, 70% of US economy is driven by the consumer. If the consumer has money to spend, they will spend it, and that's going to drive inflation growth. So, or excuse me, economic growth, and put perhaps a floor on inflation. Because rates are high, or high certainly for, if your financial history is 20 years long, they sure feel high at the short end. At some point one would think that the inflation causes a slowdown. I'm stalling a bit because I think it's a difficult call on whether the Fed will change course and seek to hike again. It might be that they, just postulating for a second, you could certainly see the Fed change their stance to put a equal or greater risk on hikes and see financial conditions in the actual markets tighten significantly, and then they might not have to raise rates. And you've certainly seen the reverse of that happen. You saw that in the fourth quarter of last year when the Fed came out and said that they had changing their bias to cut, and financial conditions loosened significantly. The 10-year Treasury yield dropped 100 basis points in a 30-day period or 60-day period. And so financial conditions just re-loosens just based on the comments around directionality rather than actually cutting interest rates. So I think it's a tough thing to handicap, but I do also think that one needs to be probably neutral or conservative in terms of their view about what activity is going to happen, because I think the likelihood that inflation takes a longer time to get down to 2% is high. We could have some spikes here or there, but also general price levels are very high. And I think that ultimately also potentially cuts into people's ability to spend or what they can spend on, which also hopefully keeps ahead on inflation. So I said a lot there. So let me summarize. Probably flatter, slower reduction in inflation, lower probability of spikes, but the possibility, I still think lower probability of rate hikes over the next, pretty low probability of rate hikes over the next 6 to 12 months.
Great. I don't see any more questions. So I guess
Great questions today.
Yeah, those were great questions today.
Yeah.
Thank you to the audience. So thank you, Tim and Travis, to being here with us today. If you have any other questions to the rest of the audience, feel free to direct questions my way. My email is available on the website under the investment team. So thank you to participants, and we hope you found this webinar informational. And just a reminder, we'll be posting the recording of this webinar. It'll be on my FFTC/resources as soon as possible. So thank you very much. Thanks to Mercer.
Thanks, everyone. See you all next quarter.